Hey, 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 welcome back to another episode of Friday Foods and Facts with your favorite guy, me. So, as I told you, I'm going to talk today about credit and the movement that we've seen in the market as far as rates and how to be successful in both right now and in the near future. So, I'm just going to dive into it. Let's get started here. So, first off, let's talk about rates. Uh, the market this week, it's been up, it's been down. It's been up, it's been down. We saw some rallying back on rates with the CPI. The CPI last week towards the end of the week, and things went well. And then the Fed began to talk about like they didn't like the positive activity that was seen in the mortgage market, and that they want to continue to try to stave off this inflation, and that they're still going to still going to inflict some more pain. So then that caused things. We lost a lot of what we got back, like soon after. Probably like Monday, and then there was a bond auction, and the bond auction went well. So then rates came back down a little bit. So we, had some gains there. So it was like, all right, cool. But then again, Fed hop back in and they're like, no, we're not done yet. So they're basically like making the same mistakes that they made, during the pandemic, as far as like saying that the inflation is transient and not moving with it accordingly. And I think what they're trying to do is cause like a job market recession, which I think they believe is going to kind of recorrect the housing market some. And then the rates will drop with that. But then in that's going to, I believe it's going to open up more people back into the market, with the same amount of inventory. So I don't know if it's going to be as effective as they think it's going to be, and I don't think in my personal opinion, I don't think it's the wisest to send our workforce into a recession. Just with the state of everything, the global economy and such. But hey, what do I know? I'm not the Fed, right? But with that being said, it's definitely still a good time to get into the market, even though there is fluctuations up and down. As a whole, things are improving, so rates are slightly starting to come down a little bit, which goes to what I've been talking about for the past, few weeks or month or so. Just that I do believe that by second quarter, things should be back into a little state of normalcy. So it's definitely something to keep your eye on. But if you can get into the market right now, let's do it, right? So, speaking of which, I want to show you guys something. So, credit, right? Credit is something that is a major driving force in the mortgage industry and in what we do. And it makes a major determination on what's available for you as a borrower. And so I want to elaborate on that a little bit more here. Okay. With credit, there comes different statuses, so to speak, from the aspect of, like, let's say if you had like maybe a foreclosure or a bankruptcy or something like that, and you're trying to figure out like how long do I need to wait before I can actually act. And so I want to go over those waiting periods because I do want to get everyone in a mindset of what it's going to take to be successful. So There's different entities that lend. There's conventional, and in conventional, you can get loans via Fannie Mae or Freddie Mac, or you can do a portfolio loan. But typically, it's going to go through an agency like Fannie Mae or Freddie Mac. And then there's the FHA, and then there's the VA, and there's USDA, right? So USDA is like for agricultural loans, rural areas. VA is for the Veteran Administration. So it's for veterans or spouses of deceased veterans. Only those two. It's not for the children of the veteran. It's not for the spouse of a living veteran. If the veteran is still living, they have to go to the application. They have to be the first person on. But if it's the spouse of a deceased veteran with I'm sorry, I'm drawing a blank right now. It's right at the tip of my tongue. If it's the spouse of a deceased veteran with a wartime inflicted injury, that was their, subsequent cause of death. So like either maybe they died on the battlefield, unfortunately, or maybe they had contracted some type of disease to where they had to receive disability from the VA, and eventually they passed on. That would make the spouse eligible, thus making it so that you can use that VA eligibility to obtain a property, right? And then there's FHA, which is a lot of times it's associated with first-time home buyers. It doesn't necessarily have to be a first-time home buyer. The reason behind that is because FHA only allows you to have one FHA mortgage, typically speaking, unless there's a scenario that comes across where it's a extenuating circumstance, right? And those are more defined. And if you believe that you may be someone of that type of situation, give me a call. We can dive a little bit more into your scenario. But those are your basic groupings, which you can see here in the window. Yeah, Fannie Mae, Freddie Mac, FHA, VA, and USDA. Now, talking about waiting times. If let's say, for instance, if you've had a house before and your house went into foreclosure, due to like you had to let it go, or maybe you just couldn't make the payments anymore, you fell behind and you couldn't get caught up, or you did a short sale where you sold the house in lieu of the debt so that they wouldn't foreclose on you, but you were behind, So something like that, those have different waiting periods. If it's a straight up foreclosure, as in like you let the house go, didn't make the payments on it, and it was either confiscated or you returned it back to the bank, there's going to be a 7-year waiting period on that. You have to wait 7 years per Fannie Mae. See, that's right here with Fannie Mae. They want you to wait 7 years from the point of completion of foreclosure. With Freddie Mac, the waiting period is 4 to 7 years, and it says with max LTV of 90%, which means the max loan to value of 90%. So if you're putting down at least 10%, Freddie Mac is going to be a little bit more lenient and possibly allow you to get into the property in 4 years minimum, or up to 7 years. Now, the reason that ranges is because the system does read your credit history. And when it reads your credit history, it makes a determination of whether or not it's going to lend. And so 4 years from the point of foreclosure, maybe you've done some things and you turn your credit around drastically and you're in a really good spot. The system may feel comfortable and say, okay, we'll let you get a house again if you're putting down 10%. Or let's say maybe you're still in the process of rebuilding and you want to try that 4 years. The system may say, we don't think you're quite ready yet. Give it a little bit more time, reapproach the subject. So that's where you're going to see the variance of 4 to 7 years. But if you're not putting down 10%, then no matter what, you're going to have to wait the 7 years with Freddie Mac. There is no leeway there. The 10% is risk mitigation. You're going to put a decent amount of skin in the game, so then don't think you're going to walk away from it again. And they think that you probably learned your lesson, being that you saved up this money over, the course of 4 years minimum to be able to obtain home ownership again, right? So that's where that variance comes in. Short sale or deed in lieu, meaning like you sold it for less than what you owe on the property because you couldn't afford to continue to make the larger payment, and then they make a adjustment to the payment plan, something that you can pay off, but you haven't paid it in full. So that is going to result in 4 years for Fannie Mae, or see, there's a little nuance there, 2 years with documented extenuating circumstances. So an extenuating circumstances, let's say you had a death in the family, and the family size shrunk and the income base shrunk. So now you can no longer afford to make that payment, right? And you do a short sale. Well, if you can show, that extenuating circumstance happened where X person passed on and you lost that source of income, and that's what led you into the situation where you can no longer be able to make this payment, there could be some leniency given there and let you get into another house into 2 years, one that you can afford, rather than you having to wait 4 years, period, right? And so that's a Fannie Mae rule, whereas Freddie Mac, they're like, nope, you just got to wait the 4 years, and that's the bare minimum, So Fannie Mae is a little bit more forgiving on the deed in lieu short sale type situation. Freddie Mac is a little bit more forgiving on the overall foreclosure scenario, provided you put some skin in the game, put something up so that you're not just going to walk away from it again. Okay. Now, bankruptcy is a little bit more common nowadays from the aspect of most people that experience foreclosures or deed in lieu and short sale. Those types of scenarios took place back when the mortgage meltdown happened a lot, around like 2012, 2013, 2011. You were starting to see a lot of those. So for most people, that 7-year time period has passed. I mean, really, if you look at all the way out to 2014, where there was programs, like the HARP programs and so on and so forth, which was helping people refinance so that they didn't lose the homes. That's when you really start to see a decrease in foreclosures. So that's 8 years ago. Most people, again, like I said, are already out of that 7-year window period. That's not going to stop them from being able to get into the market now. But you are seeing a lot more people having filed bankruptcy as of late, just with the pandemic, so to speak. People have lost their jobs. They've used credit cards or whatever to try to float themselves, and maybe they put themselves into a financial bind, unfortunately, just due to the economic situation. And now they have to file for bankruptcy because they're unable to pay those debts. Well, if something like that happened to you, let's say right now, you're filing the bankruptcy, then according to these charts here, you're going to have to wait at least 4 years from the point of discharge for a Chapter 7 bankruptcy, or 2 years from the point of discharge for a Chapter 13 bankruptcy. So discharge meaning you've gone through the entire process and then you've received your documentation from a court saying that this bankruptcy has been discharged. You've completed the entire thing, right? So from the point that it is actually discharged, then you must wait 4 years for the Chapter 7 or 2 years for the Chapter 13. If it was dismissed, that means you started the process, but then didn't finish the process, and you went back to the court and they dismissed the bankruptcy. Well, then you're going to have to wait 4 years because you didn't do what you said you were going to do to, ensure that you completed the bankruptcy process. So they're like, well, since you haven't proven to us that you're going to complete this process. We're just going to make you wait, which is going to give you the opportunity to build your credits and life back together, and then you can approach getting a house, right? Because they don't want to create a situation for you to default, because it's not healthy for you and it's not healthy for the economy. As I've spoken about before, our economy is tied heavily to what goes on in mortgages. Trillions of dollars are traded a year. And so, as a result, it's a major driver of our economy. If the mortgage market crashes, our economy crashes. They don't want that to happen, right? So they're going to put safeguards in place to make sure that you are eligible to pay back, right? Like the ability to repay is a major thing. So they don't want to set you up for failure, and they don't want to set us up as a country for failure, right? Now, when it comes to FHA, okay? So their foreclosure rules are different, as you can see here, versus Fannie Mae and Freddie Mac, right? Their waiting period is less. They've shortened it down. They're looking at 2-year waiting period rather than 4-year waiting period in most scenarios, because it is a government-backed loan, and there is a upfront mortgage insurance premium that is typically paid. It helps to kind of absorb some of the foreclosure, but they're more stringent on the guidelines as well, and on their properties as well. So with that combination, it makes it to whereas they will create the opportunity for you to be able to get into something a little bit sooner. Because again, they do want to continue to stimulate the economy, stimulate the market, so they're willing to take on a little bit more risk, but there's more that comes involved with FHA, from the aspect of that mortgage insurance premium. I've talked about it in the past, and the mortgage insurance premium is something whereas you pay it monthly, depending upon the amount of equity that you have in the home at the point of origination. You will either pay it for the entire life of the loan, or until you refinance out of the product, or for at least a minimum of 11 years. So, that's constantly building, which is a protector. The mortgage insurance is there to protect, the lenders. And in the FHA case, it's a government-backed loan, it protects them. In conventional case, since it's, a conventional loan is private money, the PMI protects the lender. So, you have that aspect. For the VA, the wait time is shortened as well, because sacrifices were made, right? You, as a person, made sacrifices to go into the military, and your reward is multiple different things when it comes to the VA home loan eligibility. The ability to get into the house with no money down. The fact that you don't have to pay monthly mortgage insurance. The fact that you possibly might not have an upfront mortgage insurance, which is called the funding fee for the VA, and that's determined based upon your percentage of disability that you receive. That funding fee may be waived because, again, of the level of service and things that may or may not have happened to you while you were there. So, there's variances in there, and they're a little bit more lenient as well, because you're establishing freedoms for people like myself who didn't enroll. And so thank you, right? We recently just came off of Veterans Day. So again, thank you. And so the wait time for that is 2 years for foreclosure. And then same thing for short sale or deed in lieu is 2 years for the date of completion. For the bankruptcy, it is 2 years, and that's for Chapter 7. And for Chapter 13, it's 1 year, but like, okay, so I want to go back. This grid here, it's not hard and fast that this is what it's going to be. You may have waited the 2 years or the 3 years, for the appropriate time period. But if you are not, if you haven't met the other requirements, like credit score or just the repairing of credit history in general, then the system may not say okay, right? It may not give you the okay. So you do have to take these with a grain of salt. Same thing with the USDA, and as you can see, the time period here, 3 years, because again, it's a situation like where we need farmers, right? We need food, right? We can't just grow everything in a lab. I mean, I guess we can, but like, yeah. And so we need to be able to have those who are going to farm, they need farmland, right? They need a house. They need to be able to process things, so on and so forth, so we can feed ourselves as a country. So we have different turn times for them versus conventional as well. 3 years from the foreclosure point, 3 years from the deed in lieu, and then we're also looking at 2 years from Chapter 7 or 1 year from Chapter 13. So, all in all, if you've experienced one of those types of situations, there's going to be some time that you have to wait. And my recommendation is, if you're in the midst of a bankruptcy, do what you can do to get through that as soon as possible so that you can then initiate that time period so that you can become eligible for a home as soon as possible. If you've already been through the process of a discharge or dismissal and you want to get in the home, the time period has expired, make sure you have that paperwork, right? Like, get that, have it with you, because it's going to be important to the process, because you're going to have to be able to show that to the underwriter that, yes, I've been through this process and here's the results therein. Also, they're going to need to see the schedule of debtors, the people that you owed, and, to make sure that they were taken care of for that. If they maybe were removed from the bankruptcy, what the current status of that is. So that information is going to be pertinent. They're going to need it. Hold on to it. And then if you are going to look to get into the market and you cannot find that paperwork, a lot of times you can go back to the lawyer that you filed the bankruptcy with, and they may have a copy of it, or you can go to the district and the court that you filed the bankruptcy with, and you may be able to obtain documentation like that. A lot of the places now have digital record keeping, so you can log in online and then you can search your docket information, by like date and name, and pull up that information. Usually there's a fee associated with the release of the digital version, and it's like usually a per page type fee. If you don't have the ability to obtain it digitally, like to download it or something like that, usually you can make an appointment, and then there will be a cost for them to print it per page, and they'll you can attain that information just by calling in, and they'll let you know. And then like I said, hold on to that, but do know that if you can't find it, there's going to be a cost. Now, if you're looking at foreclosure, usually foreclosure shows on credit. Also, title searches will show that there was a foreclosure. Public records, you can find the foreclosure documentation as well. But you should have received information about when the foreclosure took place, because the foreclosure rules start from the point that the foreclosure was recorded, not from the point that they told you they're going to initiate foreclosure. So like let's say they told you in January that they're going to foreclose on your property, but they didn't actually foreclose on it until April. Well, the foreclosure doesn't start from January. It potentially starts in April if they recorded that information with the city and the county that the property was foreclosed on in April. If they didn't record that information until June, then the foreclosure time actually doesn't even start until June. So you do want to know when that information was recorded. And generally speaking, the documentation will tell you that this information was recorded on X date, so that you know what date that you have to go off of. Find that information, hold on to it. That's an important document, along with the same thing with the bankruptcy. Like, you don't want to lose that information. Same with divorce decree, right? You don't want to lose that information. Usually you can reobtain it online, but don't lose that information, because it will come in handy down the road. So, those are important documents, pertinent documents that you want to keep, because you're going to need them for the mortgage process. All right. So with that being said, I am going to end the episode here. Next week, I'll talk about some of the do's and don'ts. I do know that next week it is Thanksgiving and it's Black Friday. So it's going to be really short, really sweet. The reason I'm talking about credit now is because I do want you guys to start getting ready for what I believe is going to be an opening of the floodgates come, second quarter next year. Everybody's going to want to get into the market because rates are going to come down. So you have to make yourself eligible now. So let's go ahead. Let's start doing those things. This is some information that will continue into next week. I'll be talking about, like I said, the do's and don'ts. And then I'm also going to mention a credit partner that I deal with, which then will be following me the subsequent week after Thanksgiving. So the week after Thanksgiving, I will be having a credit partner on so that they can discuss with you some of the things that they can do to help you build your credit back up, and how quickly things can get done and turned around, what some of those associated fees are, how you can get in contact with them so that you can then be successful when the time comes. All right. Well, thanks again for tuning in for another episode of Friday Foods and Facts. And I look forward to seeing you next week. It will be short and sweet because it is Thanksgiving and there's a lot of food to eat. So I'll talk to you. See ya.